Hi, this is Scott Hastings with Mortgages by Scott. And if you have been wondering what a assumable mortgage is, then you're in the right place. So, right now, this is being recorded in October of 2022. Obviously, mortgage rates have gone up a lot since the beginning of the year. Um, People were getting mortgages in the 3% range, even in January, February. Now, here in October, we're over 7%. So, my whole career, 20 years, always heard about assumable loans, but really, we haven't been in a environment like this in a really, really long time. So, an assumable loan was a neat feature for FHA and VA loans, but it really was never practical, never came into, you know, um, being needed. But it is now. So there's a lot of sellers out there that have their houses on the market. I've got, quite a few right now that, still have these FHA loans and VA loans with these super low rates. Well, basically, what an assumable mortgage is exactly what it sounds like. If the buyer of the house qualifies for the loan, then they can just take it over. They can take over the mortgage that's on the house then, currently. Um, and Whether that's an FHA loan or a VA loan, it's not, you're not able to do it on a conventional loan or a jumbo loan, but the other types you can. But it doesn't work the same way. So, like, I work for a lender. Um, we don't manage these loans. They're going to be always managed by the loan servicer. Loan servicer is the organization that collects payment. So every month when you make your mortgage payment, it's not like it goes directly to FHA or VA. It goes to a servicer. Now, the qualifications are in general about the same as they would be for a normal FHA or VA mortgage, but probably what's going to be the difference is servicers aren't typically in the business of doing mortgages. So it could be, a big headache, for lack of a better word, but it could be a headache that's really worth doing because you'd save so much money. Um, Here is one of the downsides of an assumable mortgage, though. You're just assuming whatever the current balance of the mortgage is that you're assuming. So, for example, if you're buying a $400,000 house and the client has an FHA mortgage at 3.25%, you'd love to assume that, but they've only got a $200,000 mortgage balance. That means you're going to have to come to closing with $200,000. So you can't borrow any more money on that mortgage than is already there. And I would say that's the major downside of it. Um, so, you know, it is a great thing. I would say it's something to definitely look into. If you come across a listing that has a mortgage that can be assumed, but I would say be careful. I can't speak to any particular organizations or servicers, but I will say that just because you might call a servicer and ask them if you're approved for the mortgage, they might say yes. And then when you go through the whole long, painful process, you might find out at the very end that you actually don't qualify. So I would have a backup plan. Have clients, like I mentioned earlier, right now, they are, in the process of hopefully assuming a mortgage that has a really low rate, but we've already got them pre-approved in case that falls through. Because they'd much rather buy the house, even at a higher rate, than to lose the house, lose earnest money and due diligence money and what have you that they've already got into the deal, especially if they're selling their current home. So anyway, is just sort of a really high level overview of what an assumable loan is. If you have any questions, please feel free to put them in the comments. And I'll get back to you, or you get on my website, mortgagesbyscott.com. If you found this video helpful at all, I would love it if you would click like and subscribe. That really helps me out. So anyway, thanks a lot.